Good afternoon. Welcome to the Trust and Estates section monthly program. I'm Andy Kushner, co-chair of the section. I have a few announcements before our program starts. First, you'll receive your MCLE certificate materials and a copy of the program within 72 hours. After the program, please take a moment to complete the survey. A survey link will pop up right after we conclude the webinar. The Trust and Estates section and all of its webinars are sponsored by the Sanborn team and Geffen Real Estate. This webinar is also sponsored by Manufacturers Bank. The Sanborn team has been sponsoring the Beverly Hills Bar Association's Trust and Estate section since 2006. Servicing clients for over 35 years, the Sanborn team gives members and colleagues attractive results and peace of mind with a depth of knowledge of probate, trust, and conservatorship unparalleled in the industry. The Sanborn team's ongoing sponsorship demonstrates a tangible commitment to the probate and trust community and the Beverly Hills Bar. They are ready to handle any and all sales of real property in Southern California. Think of them as the first resource for your real estate needs. Geffen Real Estate is owned by broker-owner Ori Gadish, who is a high-energy, compassionate, and experienced to successfully serve you. Having sold over 1,400 residential and commercial properties statewide to date, specializing in probate and trust, including luxury and investment properties. REIT offers various programs to best meet your clients' needs, including auction, occupant relocation assistance, ordinary as-is sales, and renovate now, pay later. REIT is a fierce negotiator, originally from Israel, and currently lives on a fruit tree farm in Beverly Hills with her farmer professor husband and 4 young daughters.
My name is Orit Gadish. I'm the owner-broker of Geffen Real Estate. I specialize in probate, trust, and conservatorship real estate sales. I handle both residential and commercial real estate. Even though I have a large team, I will personally handle your file. Please remember that I will always have your best interest in mind, and I look forward to helping you with your real estate needs.
Finally, we have Manufacturers Bank, who has been serving the Beverly Hills professional business market for the past 60 plus years. Its trust and estate group manages over $350 million in trust accounts. Brian Flores, Vice President and Senior Relationship Manager from the Beverly Hills office, is available to handle all of your trust and banking and estate banking needs. With that, I'll turn things over to Dina Nam for our legal updates.
Thanks. Good afternoon, everyone. My name is Gina Nam. I'm one of the co-chairs for the Legal Updates position. There's 3 cases today that I just wanted to provide everyone with an update on. The first one is called Conservatorship of Jose B. And as the name suggests, it's regarding a conservator's right to trial within 10 days of demand. Basically, the conservatee demanded trial. It happened 137 days after the demand. The public guardian was reappointed and Jose B. appealed. In that case, on appeal, the court found that although there was a statutory right, the statute didn't provide that a breach of that, the remedy would be dismissal, which is why it was directory, not mandatory. The second case is a exciting case about the California Income Taxation of Trusts, which is Stewart versus Franchise Tax Board. In that case, the grantor had established a trust for the sole benefit of his daughter, Paula, referred to as Paula Trust. It was a completely discretionary trust with 2 co-trustees. One trustee was a California resident. One trustee was a Maryland resident. In 2007, the trust had sold some stock, which resulted in capital gains. The trustees reported that on their California fiduciary income tax return and paid the tax. But later in 2012, they filed an amended return and requested a refund of half of that amount based on the apportionment rules, taking the position that 1/2 of the income is attributed to the California trustee and the other half should have been attributed to the Maryland trustee. At trial, the The court found for the trustees and said that the apportionment rules did apply and a refund was granted. The Franchise Tax Board appealed, and on appeal, the Court of Appeals found that the apportionment rules did not apply because the income was purely California-sourced income. So in that case, their original tax return was correct, where they should have paid all the income that was owed on that portion of the trust income. So the holding in that case was that California imposes income tax on the entire amount of California-sourced income, regardless of the trustee's residency, and therefore the apportionment rules did not apply in this situation. The last case is called Condal versus Mitchell-Clyde, and it involves like what is available or how a revocable trust can be revoked. So in that case, Grantor had established a living trust for the benefit of Robert Condal, and the grantor, John Martin, was the trustee and trustor. They, for reasons because of a falling out between the two of them, Martin ended up revoking the trust, but rather than following the trust terms, he relied on the statutory method found in Probate Code 15401A2. The Condal filed a petition for instruction saying that because Martin had not followed the trust's set forth method for revocation, that the revocation was therefore invalid. In that case, the court found that because the trust instrument did not provide that the exclusive method of revocation was the trust terms, that Martin could rely on the statutory method under the Probate Code in order to revoke the trust, and therefore his revocation under the statutory method was considered valid. Now I'd like to introduce Jennifer Campbell, who will introduce our speakers today. Thank you.
Thank you, Dina, and I'm very pleased to introduce our speakers today. First up, I have Chung Che. He's a member of the Hoffman, Sabin, and Wattmaker firm, near and dear to my heart as an alum. He practices in the area of estate planning, trust administration, and probate, entity formation, and tax and charitable planning. Chung is a certified specialist in estate planning, trust, and probate law, and he's also an ACTEC member. Chung lectures often and has written extensively on trusts and estates topics. We're also very pleased to welcome Sky Moore, who is a partner at Greenberg Glusker, practicing in the tax area. Sky is a recognized authority in this area, having written a leading tax treatise, as well as speaking and writing on a broad range of tax issues, including tax issues relating to real estate, partnerships, corporations, and cross-border issues. Thank you very much, gentlemen, and I will now turn it over to you. We look forward to your presentation.
Thank you. I'm gonna start, and can you hear me? Everything good?
Yes.
Okay. So I'm going to give an overview of opportunity zones and their remarkable benefits that they have. And I'm going to use some terminology that is slightly different than is in the statute, because the statute has some bizarre terminology that is rather cumbersome. Yeah, I'm going to use the word fund for the main, what's called a qualified opportunity fund that the investors have to invest in. Below that, there is a concept of a subfund, which is kind of a lower tier fund that meets certain requirements that we'll discuss. So I'll use the concept of fund, and then below that, subfund. Deferred gain is capital gain that the taxpayer recognizes that is deferred under these opportunity zone rules. And I'm going to use the word zone for the location of where the business has to be operated. And in summary, the rule is that if a taxpayer has capital gain between now and 2026, or actually backing up from 2018 to 2026, they have some remarkable benefits if they invest in a fund, and the fund in turn invests in a certain low-income areas called the zone. And the benefits to the taxpayer are truly remarkable. One is that all tax on the gain, including the 3.8% tax on net investment income, is deferred until the earlier of 2026 or a, quote, inclusion event. And an inclusion event is basically any transfer of their interest in the fund other than on death, because the estate inherits the tax consequences as income in respect of a decedent, and a contribution to a trust, a grantor trust, or to a partnership or a single member LLC. Those are the only exceptions. Any other transfer triggers the built-in gain. But as long as you hold on to the interest, you get complete deferral until 2026 of this deferred gain. In addition, if you've held the interest for 5 years, 10% of the gain goes poof and is not subject to tax. If you hold the interest for 7 years, an additional 15% goes poof and is not subject to tax. And it's only the remainder that is therefore of the 85% that's left to be taxed in 2026. More importantly than all of that is that there is a complete exemption of all tax on the interest held in the fund if it is held for more than 10 years. And this is what people really are excited about. To invest in this is one of the very few areas of the code where you actually can put the money in your pocket and not have to pay tax at all. So this is what the holy grail that everybody is after. And the game there is you have to hold your interest in the fund for at least 10 years. When you sell it, you're not subject to tax, including, remarkably, even recapture that would otherwise be picked up as hot assets or recapture or ordinary income at the fund level. The regulations expand that, fortunately, to allow this exemption on sale of property by a fund itself, except that in that situation, recapture is picked up. And so you are incentivized to sell your interest in the fund as opposed to selling the fund selling its assets. This benefit only applies to an investment of rolled over capital gain. So it does not apply to a promote or a profits interest given to someone for services, and it does, and remarkably does not apply to fresh money that ordinary taxpayers want to invest if they don't have capital gain. So this is somewhat remarkably tailored only to help people with significant capital gains, which is obviously the wealthy. And when you walk through this whole process, I would submit that this entire legislation is actually just to benefit the rich, and I can walk you through. It's actually remarkably anti. Its goal is completely perverse to what its purported intent is. When you were done with it, you'll see why. There's a number of benefits. So that here are the technical requirements in order to meet this. You have to have capital gain. So it doesn't apply to income that's recapped. If you sell real property, some of it may be subject to recapture. That is ordinary income and does not qualify. You have to have capital gain, including 1231 property. You have to elect to get the benefit of it. You have to invest within 180 days of the date that you have your capital gain event, with several caveats on that. One is that that period got extended for 2020, so that if you have gain in the first half of 2020, you can wait till the end of the year, and the 180 days doesn't start until then because of this COVID-19 situation. Second is that if the gain was recognized by a pass-through entity, you can wait until the end of the year. Either the pass-through entity has the right to make the election, in which case the 180 days starts when the partnership or pass-through entity sells, or the individual owners can make the election, in which case they can elect either when the partnership sells or at the end of the year. So they effectively can defer the 180 days to start to the end of the year. In order to invest in a fund, you have a choice to either invest directly in the fund, or you can purchase an interest in a fund from a third party. That will count as an investment in the fund. for people that have recognized gain. The benefit of the rollover only applies to the extent of the quote amount invested in the fund, which appears to include amounts borrowed, even non-recourse debt to acquire an interest in the fund. However, it does not include any debt of the fund itself that is allocated under 752. So you could borrow outside though and invest. You don't have to trace. In other words, importantly, you don't have to trace your cash from your sale into the fund. You just have to make an equivalent amount investment. Your amount invested though is reduced by any distributions from the fund to the investor within 2 years before or after the investment. That is, so that you have to look out for distributions, even of debt financed cash distributions, that will reduce the amount invested by the taxpayer. Zones you can easily find them online on Google. Just search qualified opportunity zones. They've got a map of it. That map is locked in place, and that'll be what happens through 2026. And some of those zones are really should not be zones. There are some very wealthy areas because it's based on a census that was done in 2010. It's clearly out of date, but that's what we have. And so there's very up and coming areas. For example, in Los Angeles, San Francisco, Oakland, all throughout the country. Actually, there are some remarkable areas that are included. What are the requirements for the fund? All right, so the fund itself has to be a partnership, including an LLC or a corporation for tax purposes. It cannot be a single member LLC. So almost always they'll be formed as LLCs with multiple owners to be partnerships. The organizing documents, which I think is the articles, have to provide that it's an opportunity zone and a description of the business that it will be investing in. The fund has to elect on Form 8996 to be a fund. And most importantly, for funds, 90% of their assets have to be good assets, which is defined as interest in a subfund. And you're going to see how important this is. Those are those lower tier entities that I described earlier, or actual zone property. And zone property is we'll discuss later, is tangible property that's in a zone. And this 90% test, the problem with it is that intangible assets, including cash, count against the 90%. So if the fund is sitting there holding cash, it can blow the 90% test and it will not qualify. So it could be the same with copyrights, trademarks, any intangible property. There's some minor exceptions for you get to hold cash for 6 months if it was recently invested by investors. But in general, that will blow it. And the net result is, in almost all situations, you will need to have a fund that in turn owns a sub-fund. You do not want to be investing in a fund that itself owns zone property. I can almost guarantee you it will blow the test at some point and will no longer qualify. So in all the cases that we've done, and in every one I've seen, it's a fund that creates a sub-fund. And the reason why is this 90% test. If the fund itself fails to meet the 90% test, it has to pay penalty interest of 6% per year. Right now, that's the rate. And it's not clear what happens if it continues to blow the test. Obviously, at some point, it's just no longer a fund, and everyone would have to pay their deferred gain, although the regulations don't state how long that period is, oddly. But I would have guessed you go 2 years and you're in trouble. The fund has to buy new assets. It cannot have been acquired. It cannot be pre-2017 assets. So old entities even if they own a lot of property in a zone, will not qualify because it has to be property acquired after 2017. There's no, although an ownership of an interest in a sub-fund is a good asset, there's no look through to the assets of the sub-fund. So that's why you're protected. As long as, even if the subfund owns a lot of cash and intangible assets, as long as the fund owns an interest in a subfund, that qualifies as a good asset. And that's why everybody's going to be doing this, and fund versus having a subfund. The subfund itself has to also be structured as a partnership or a corporation. And so in almost all cases, what we're doing is a fund owned by a subfund, and you have 99% ownership by the fund and 1% by somebody upstairs, whoever the manager is. Somebody you have, because you have to make it a partnership. Bizarrely, it can't be a single member LLC. These rules make no sense at all, by the way, when we get done with them, but you got to comply with them. So that's the way all of them are being set up. Fund is a partnership, sub-fund with a 1% owner to make it a partnership. The sub-funds are subject to a whole different set of rules than funds are. So we've walked through the test for funds. Now I'm going to walk through the test for a sub-fund. And for some bizarre reason, there's a lot of different tests that apply to a sub-fund. Number one, there's no 90% test. So that's why you're allowed to have a lot of intangible assets, including cash, most importantly, at a sub-fund. Next is they have to have 70% of their tangible property as zone property, and zone property is tangible property in a zone. So it's much different than the 90% test, much more lenient. It only applies to tangible property, and it's pretty easy to meet. Like if you have most of your tangible property in a zone, you're gonna meet this. So it's not that hard. Most importantly, new regulations that just came out in April have a bizarre twist that says that and there's some debate on this, but the way it reads is, as long as you meet this working capital safe harbor that I will discuss, you do not even have to meet the 70% test. So footnote, I'm going to talk about this working capital safe harbor. While you meet that, you do not need to meet the 70% test under the literal wording of the final regulations. Here are some rules that apply to sub-funds, but not to funds. And again, this is more bizarreness. 40% of the intangible property of a sub-fund has to be attributable to use within a zone. And copyrights, trademarks, and most importantly, cash. And here's where we get this working capital safe harbor. The regulations say that cash will count as intangible property that is used in a zone if there's a written plan for use of that cash for some purpose in the zone within 31 months of the date that you set it aside. And that 31 months was just extended by another 24 months if the period starts in 2020 because of COVID-19. So you now get like 50 some months. So if you have a written plan that says, I am going to do something with this cash, number one is that's now a good asset for this 40% test. Number two is as I mentioned earlier, that seems to eliminate the 70% test for the entire length of time that you're using the working capital. And it appears that when you're done using the working capital, now after 50 whatever months, that then you then do the tangible test. So this is a remarkable, generous provision. And by the way, you don't even need to say specifically what you're going to use it for. I am going to use working capital to buy property in a zone. That appears to work, even if you haven't identified the property, even if you don't even have the property yet. It's the way it's written is you just have to say, I am going to do something, and then you have to actually do it. So again, very, very generous rule. Next, at least 50% of the gross income of the subfund has to be attributable to an active trade or business conducted in the zone. And that's a very lenient rule. They have various tests you can apply, hours of employees worked, compensation, and then facts and circumstances. So it's pretty easy to meet one way or another. A subfund is not allowed to operate a golf course, country club, massage parlor, hot tub, suntan facility, some other stuff. Bizarrely, that does not apply to a fund. So under the literal wording of the regulations, a fund itself could operate a massage parlor and God knows what. Go figure. Other fun stuff. Let's talk about the valuation of the property for all these purposes, the 90% test, 70% test. You have a choice. You either use the book value as stated on GAAP financials, or you use original cost. So it's one of those two for doing it. Now let's talk about what is critically zone property, because one way or another, you have to have property in a zone that is, quote, zone property. And for example, for subfunds, it's 70% of your tangible assets. It has to be, so it's tangible property that is used in a zone that is acquired or leased after 2017, and it has to be placed in service for the first time in a zone. That like for example, you bring in trucks and equipment from somewhere outside the zone, or, and here's where it gets kind of weird, it has to be land that's in a zone that either you knock down, it's either vacant, or you knock down all the existing buildings, and you have a plan for doing more than an insubstantial amount of improvements within the next 31 months, in which case the land now qualifies, or it's land that has a building on it, and you take the building and have to spend an amount equal to the cost that you allocated to the building in the first 31 months. You have to basically do a massive improvement to that building, and then that building will itself qualify. In most cases, as a practical matter, for my clients, it is impossible to spend 100% of the cost of a building to improve it. We're tearing it down and relying on the fact that we have land that we are going to improve with. So we're going to do more than an insubstantial improvement in the next 31 months, and therefore all the land qualifies. So what you find as a practical matter is that what this whole zone thing what it really is intended to do, or what it incentivizes, is to tear down whatever's there and to rebuild something new. And so when you put it together, what you have is rich people that are incentivized to invest in the zone and tear down low-income housing and build new condos or new office buildings or new malls. And you, by the way, do not have to hire any of the low-income people that lived in the zone to build those things. So by what you have done as a practical matter is wiped out the neighborhoods of low-income housing and forced them out of the zone to poorer areas or more rural areas, and the whole policy is somewhat perverse. But so be it. That is the way that that it works in practice. And I can tell you as a practical matter that is what's happening, because I represent a number of clients, and without question that is what they're doing, and that's what you're incentivized to do. That's what you're required, in fact, to do. The other thing I could mention on is that it also can work for new businesses that are formed in the zone that if you're looking for substantial appreciation. So, for example, even a startup company that has high tech, that has you can imagine any number of things. A software company, high tech company, or even amusingly a cannabis company. You could be formed in a zone, and it'll meet the requirements. And if it's done through a subfund, and investors could go for the long-term play of capital gain being completely exempt. And so, beyond just being a land play, it could be a business play for companies that have substantial growth opportunities. And literally, it applies even to a cannabis company. There's no exclusion in it's not a massage parlor, and therefore it's not, or a suntan facility. Remarkably, they didn't exclude other businesses that are illegal, at least on the federal level. So it's again, so those are the two plays: is new startup businesses and then real estate. And again, it sounds like all I would say is this. It sounds so wonderful. Oh, we're going to invest in low income housing areas, low income areas. Isn't this wonderful? The truth is, it is a complete perverse policy that hurts the poor and helps the rich. And with those, that's my 2 cents on opportunity zones.
Thanks, Guy. So I wanted to partner with Guy on this topic because he's the expert on opportunity zones, and I wanted to layer his talk with some practical applications with regard to estate planning. So I want to talk about what Guy had mentioned in terms of inclusion events and the difference between doing it during or avoiding the inclusion event with a gift versus by inheritance. I wanted to talk about certain planning techniques, in particular GRATs and intentionally defective grantor trust. And then lastly, I'll try and compare 1031 exchanges with the qualified opportunity zones. But before that, let me just tell you a short joke to provide some midday humor. Let's say a lawyer meets with his murder suspect client, says, "I have good news and I have bad news." The suspect client says, "Well, what's the bad news?" The bad news is that your blood is all over the crime scene and they have DNA evidence to prove that you committed the crime. Says, "Well, then what's the good news?" The good news is you tested negative for COVID-19. All right. So, in terms of the inclusion event, as Sky had mentioned, look, you want to be able to avoid the inclusion event because that's going to trigger the deferred gain prior to the end of 2026. Well, so what does it mean if you're trying to gift a quality opportunity zone investment versus, keeping it until you're passing? Well, Sky also mentioned that a gift to pretty much anybody is going to be a trigger for the inclusion event, with one exception. Besides the partnership and the single member LLC, it's the Grantor Trust. So, if you're thinking about a situation and the parents or whoever has the fund and they want to make a gift, you better be very careful in the way that they do it. Otherwise, it's going to trigger the deferred gain prior to the anticipated period of the end of 2026. The other thing that you have to worry about, if you are able to successfully transfer it to a grantor trust, is that one of the benefits of a grantor trust, and I'll explain this a little bit more later, but is the fact that the parents are considered, or the grantor, I should say, is considered to be the taxpayer for income tax purposes. And so at some point, the parents might say, "You know what, I'm tired of paying the taxes. I want the trust to pay its own taxes." And there's a mechanism in which they can release the grantor trust and essentially powers and essentially turn off the grantor trust status. That's a no-no in terms of the inclusion event, because that's going to be a trigger and that's going to cause an immediate taxation of the deferred gain. So that's another thing that you need to watch out for. So if you're in another situation that might occur is with respect to a GRAT. A GRAT is a vehicle in which you contribute assets, the grantor receives the annuity, and basically you have to pay interest back to the grantor on top of the annuity payment. That interest payment is so low right now, it's 0.4%. So it's a great vehicle at this time. But once the term expires, whatever the balance is, and the hope is that it appreciated enough that there's a balance, that balance will pass to whoever you designate as the beneficiary, completely tax-free. And so you have to be careful here in the situation with the qualified opportunity zone, is that if you transfer that balance to a non-grantor trust or directly to the beneficiaries, that's also going to be an inclusion event. So that's another thing that you want to watch out for. Inheritance the rules basically say that death is not an inclusion event. So inheritance is a good thing. And it's a good thing even in the grantor trust context, meaning that, as I indicated, if you're dealing with a gift, a transfer or a change in status from a grantor trust to a non-grantor trust is an inclusion event. Well, the one exception is death. So if the death, the grantor trust holds the qualified opportunity zone investment, but then it, upon, basically due to the death, it becomes a non-grantor trust. That is not a triggering event. So that's something to be mindful of. One thing that you have to be careful, even in an inheritance situation, is let's say the holder of the fund dies, there's no triggering event, but then it goes on to an ongoing trust for the benefit of the beneficiary. And let's say the trustee has a blanket discretion to make distributions. So it's not mandated. Well, you have to be careful in that situation. If the trustee exercises their power and make a distribution of the fund investment as an asset to the beneficiary, that could be a inclusion event. So that's different than if you had a term in the trust that basically says terminate at age 25 and distribute everything to the beneficiary. If it's within the terms of the trust and it's a mandated distribution, that is not an inclusion event. So those are things that you need to watch out for. Again, the benefit of this inheritance is that the beneficiary can tack on the decedent's holding period. So, if the decedent held it for 2 years, then the beneficiary only needs to hold it for another 3 in order to get that 5-year, elimination of 10% of the deferred gain. However, as Sky had mentioned, there is no step-up in basis, Section 1014 step-up, because it's income in respect of a decedent. If there's a non-qualifying investment portion, it will receive a basis step-up at death. So I'll give you an example. Let's say you have a qualifying gain of $120, but you want to invest $200, so an additional $80 to the qualified opportunity zone investment. Well, the 40% of that will receive a basis step-up at death. The part that's qualifying, the 60% will not. But the 60% can receive, with a holding period of 5 years, can receive the 10% elimination of gain. So let's move over to the techniques. So as I mentioned, the two that I want to focus in on are GRATs, which I've explained, and a grantor trust. So in particular, let's say we do a sale to a defective grantor trust. The reason why you want to do the sale, and the reason why it's a good planning technique, it sort of freezes the value. So hopefully you can have it appraised at a lower value. Then you do the sale, and then it sort of freezes the the value of it for the sale purposes. And because the interest rates are so low today, for example, I think the short-term rate is 0.17%, which is 0 to 3 year term. And the midterm 3 to 9 year is 0.41%. And the long term, which is, and the midterm is 3 to 9. And then the long term, which is the greater than 9 years, is 1.12%. So in essence, if you do a sale where the parent or the grantor or the seller essentially takes back the note, they're essentially giving an interest-free loan. Now, one bad thing about the GRAT is that you do have to survive the term. Otherwise, all those assets come back into the estate for estate tax purposes. And so, but the disadvantage to both techniques, even though they have their advantages, is the basis is transferred because now there's questions about the sale, which I won't get into because it's beyond the scope of this talk. But the idea is that if the beneficiary were to ultimately receive the same basis that the parents or the grantors had, then they're going to be at a deficit because whenever they sell the asset, there's going to be a large capital gains tax. So if you're in a situation where either way, if you're talking about GRAT selling the appreciated asset or the grantor trust selling the appreciated asset, and then investing in the qualified opportunity zone fund, you have that immediate deferral of the capital gains tax and potential partial elimination of the tax. But you also have the ability that possibly with a holding period of 10 years of the fund, that you would eliminate the gain on the fund. So, this is a way to be able to transfer these assets, hopefully at lower values, and then take advantage of all the mechanisms there are, but to be able to also have the basis advantage as well. So the last thing I sort of want to talk about is sort of a comparison between the qualified opportunity zone investment and a 1031 exchange. Everyone's sort of familiar with 1031 exchanges. The one thing that was changed under the Tax Act is that they really limited 1031 exchanges. It used to be before you could do it with artwork and other assets. Now it's just limited to real estate. So that's what I want to focus in on. Whereas a qualified opportunity zone, you can basically do it with any capital asset. So you can do it with artwork, collectibles, and stock. The difference, and Sky also touched upon this, is with respect to the tax deferral, is that gain for 1031 exchange, gain is deferred if the relinquished property is disposed of, and within 45 days, replacement property is identified and acquired within 180 days of the date of the relinquished property, basically after you sold the other property. And the other things that are required under the 1031 exchange is you do have to invest or reinvest all the amounts or gain is recognized. And so what happens in terms of people is they will continue to do these 1031s until eventually the holder passes away and you get a step up in basis. And that's sort of the plan with respect to 1031s. On the other hand, with respect to the tax deferral with the qualified opportunity zone, gain is deferred if proceeds are invested in a qualified opportunity zone within 180 days. And I know Sky had talked about the COVID situation that is extended. You only need to invest the gain portion. So you can essentially pocket the basis amount. So that's an immediate difference right there. And the deferred gain is recognized at the end of 2026 unless there's an earlier inclusion event. So, in that sense, the qualified opportunity zone isn't as good as a 1031, but depending on how much your basis is, if you have a significant basis in the asset, maybe that's the better way to go so that you can receive that. And then again, if you hold the qualified opportunity zone investment for 5 years, you can eliminate 10% of the deferred gain. On the income tax basis side, again, you take a look at the situation, as I mentioned, basis for a 1031 exchange is carried over to the relinquished property, or from the relinquished property, I should say. And then, once the holder of the 1031 property passes away, then you get a step up in basis. Whereas for a qualified opportunity zone, basis in the zone fund starts at 0, but it's increased to fair market value after the 10-year holding period. And the decedent, again, whatever their holding period can be tacked onto the beneficiary to basically accomplish the 10-year holding period. But as I said before, and as Sky mentioned, there is no step up because it's IRD. The one other thing that I want to mention in terms of difference between the 1031 exchange and a qualified opportunity zone is with respect to state taxes. So the 1031 is basically recognized by all the states. So gain is deferred for state income tax purposes as well as for federal. For the qualified opportunity zone, only 2/3 of states conform to the federal qualified opportunity zone rules. California does not. I think there might be a proposal, but I don't believe it's passed yet. So you need to watch out for the possibility of a double taxation. So the example is, let's say you have a non-resident taxpayer, non-California resident taxpayer, I should say, who's selling California property, and then is going to use that money to invest in a qualified opportunity zone in their state which is conforming. So you have a situation where you may have an immediate tax for California state tax purposes in the year of the sale, but then, you know, when you have the situation with your state that it conforms to the qualified opportunity zone investment or rules, they won't recognize that gain until 2026 or an inclusion event. So you might not have a matching credit because you're paying California taxes in one year and you're paying the other state's taxes in another year. So it's an important thing that you need to be watching out for so that your clients can be apprised and avoid this double taxation. So I think that's pretty much all I wanted to deal with. I think we can now take questions, and Jennifer, I think, was going to review the questions for us to answer.
Yeah, hi, Chung. The question that seems to be on everyone's mind today is do we think Joe Biden's going to repeal 1031 exchanges if he's brought into office? And do we think he might repeal the opportunity zone rules?
Sky, do you want to take this?
He apparently gave a speech today where he announced that he intended to repeal 1031, and all I can say is I hope he does, and I hope he repeals opportunity zones. So that's. But I will tell you, he's got a political slog to overturn opportunity zones because it sounds so wonderful, and you really have to dig into it to understand how perverse it is. And so far, it was passed by both Democrats and Republicans overwhelmingly, and so it'll be a difficult slog for people to figure out what's really going on.
Although, Jennifer, I would say that I thought more people would be focused in on Joe Biden lowering the exemption immediately and possibly raising the tax rate on gifts and estates.
Yeah, that will probably come up at another program, but today, fortunately, we've got folks zeroing in on our topic. So, Chung, do you see having a qualified opportunity zone investment as a usual tool in the estate planner's kit, or is it more esoteric like our Cuperts that really only come out under specialized circumstances?
Well, no, I think the biggest thing is the fact that you can utilize any capital asset. So if you have a situation where somebody has a valuable artwork that's appreciated over time, or just a brokerage account, there's a possibility of deferring it without, worrying about doing some other techniques, possibly charitable remainder trust or other things that you would usually employ, to try and either, void or defer the gain.
Interesting. So it has much wider opportunity to be used than just real estate investment, which may be what it sounds like at first blush. All
Yes.
right. Let me check and see if we've got any other questions. I'm not seeing any there. I think we already disposed of the issue about step up versus IRD. If you want to readdress that, I think probably that's another 1031 versus zone investment comparison point, right?
Yeah, I mean, like I said, I think, those are things that you really need to be cognizant of ways to be able to do it. And it's going to differ, like I gave the example, if you have added a non-qualifying portion to the investment of the fund, then you are going to get a step up on that portion. And then for the qualifying portion, you sort of have to rely on the 5-year holding period to eliminate the 10% of the gain. And then, of course, you have the elimination of all gain on the qualified opportunity zone investment if you hold it for 10 years. So yeah, I think there's avenues there. Unfortunately, and I think Sky had mentioned this. If you had done it earlier, you could have eliminated another 5%, but that required a 7-year holding period. So you would have had to do it, at least I think by the end of last year, or by the end of last year. So.
And to have nerves of steel if it was a market-based investment, right? Given how much volatility we're seeing in that sector of the economy. So, Sky, it sounds like you've done quite a number of these funds. Chung, are you seeing many of your clients investing in them?
I've talked to a lot of clients, a fair number of clients about the opportunities involved. I haven't had too many takers, and I think, but I think Sky can talk more about this as there are funds, sort of easier investment vehicles. I think the reason why a lot of investors or a lot of clients sort of shied away from it in the beginning was they didn't want to have to look for the property themselves and things like that. But now that there are vehicles where they can just plunk down money to be part of somebody else's investment, I think that may garner more interest.
Mm-hmm.
Right, Sky?
Yeah, we were selling out overnight up until March, and including for some huge real estate developments, but one of which included a huge double hotel. And after COVID-19, the enthusiasm for that sure shrank. So we're in an interesting era right now. That's for sure.
I can only imagine. I think it would probably take a fairly far-sighted investor to be willing to plunk down a significant amount of cash these days with all the unknowns rampant in the economy and in the long-term forecast.
Yep, particularly for hotels. Yep.
Okay, I don't have any other questions. I think we have a few extra minutes. Last call for questions. If you want to type those in either at the Q&A block or in the chat block, we can pick them up.
Going once, going twice, sold to the highest bidder.
Right. I want to thank you both so very much for joining us today. This is a really interesting topic. I think it's much more flexible than people otherwise realize. And I thank our audience of roughly 42, 43 people. And we'll see you again soon. Bye.
Cheers.
Thank you for the opportunity.
Thank you.